Hi, my name's Jay Norris, and I'm a trading instructor at Trading University. As always, we need to remind you trading involves risk of loss and is not suitable for everybody. Today we're going to give you a quick lesson on trading on market-generated information. That's a phrase we throw around a lot, and we think it's important that you understand what that means. Market-generated information means using only inputs or information provided by the market itself. Example, using a market's high, low, and closing price in your analysis. Let's go to the Euro chart today, and we're going to give you an example of that. We're just going to show you how to use the market's high and low prices here. The first thing I see coming into the U.S. session is the market retraced itself by a predictable amount. Here, and I'll show you exactly what I mean. I'll take my retracement tool and I'll mark the high, and I'll come down and I'll mark the low. And you can see it topped out right around that 625. Hopefully you can see that 625, that's a Gann level. Topped out between 50% and 625. Pretty predictable level. You'll see that quite a bit. What that's telling us is the market's softening up. You had a very strong market, but then it was not able to get past that 625, so you put in a bearish pattern. So we could say definitively this is a bearish pattern because it could not close beyond that 625, right? So as long as you're closing below 625, that pattern is bearish. So we're making what we call a fact-based assessment based on market-generated information. Fact, the market couldn't get beyond 625 on a closing basis. Therefore, that pattern's bearish. Now we come down, we see it again where you have a pretty good sell-off. The market retraces by a somewhat predictable amount. Here we'll show you. This time it tops right around 50%, which is pretty common in the market. So now we know we have there, that purple line is the 50% and the orange line is my 625. So markets again confirming this pattern's bearish. So now we have, essentially we had this bearish pattern to start. Now we have a new bearish pattern. So basically you had two bearish patterns in a row. Okay, now don't forget you want to take that overall pattern also. So take the high of that move, right? The high to the new low, and you can see now you have a couple of bearish patterns overlapping each other. So at the very least you have two bearish patterns. You have the overall pattern, high to low, and you have the secondary high to low. And so you have two bearish patterns overlapping each other, right? Let me get rid of some of these lines. Don't want to confuse you. But I want you to see the point that you have two bearish patterns in place, long term, and we'll call that the intermediate term bearish pattern, right? Then you start to see a pattern of another lower high right here, right? Now here's where it gets really fun. Here's a lower high, and then here's another lower high, right? Now, one of the things we learned on a trading flow right away is you look for that pattern of lower highs. Lower highs, lower high, lower high, lower high, indicates that you want to be taking sell signals, right? Now, this is a Forex chart, and I like the Forex chart. It gives me pretty good detail. This is a 3-minute chart overall, and all we're doing is demonstrating the advantage of using market-generated information. That is not trading on what you think, but what on the market is telling you to do. Now, we know markets are fractal in nature, meaning you'll see the same patterns on the lower time frames as you do on the higher time frames. That's really cool. It's actually a two-way mechanism also. I mean, what you see happen on the higher time frames gets replicated on the lower time frames, but it works the other way too. What happens on the lower time frames will get replicated on the higher time frames. So that being said, we're going to drop down to a lower time frame because I'm really fascinated with this little move here. It doesn't look like much on a 3-minute chart. Here, let me put a block around it. This doesn't look like much on a 3-minute chart, but I'm going to show it to you on a lower time frame. Here, before we go down, drop down in that lower time frame, I'll just mark that retracement out for you with my retracement tool, and you can see, aha, there's that 625 level again. So in here on a lower time frame, that might be of interest to us, right? Because if we're going to trade in the direction of the pattern, basically we're going to trade on market-generated information only, and the idea of that is to wait till you have a couple of patterns aligned and then take that trade. So we're going to highlight that box right there, and we're going to bring down a tick chart. And we're also going to use a futures chart here. I like the futures chart because the futures chart gives me the ability to sell a specific level, right? I mean, I could put an order in to sell it at 70, and if it trades 71, I'm guaranteed to fill. Likewise, I can get out at a very specific level, and that's going to help us out when we're trading with market-generated information only, and you're going to see that, okay? So here's what we're doing. This area on the chart right here is this highlighted box on the 3-minute chart. Okay, this is a 50 tick chart. This smaller chart, the futures chart, it's a 50 tick chart. So it's a very fast moving chart. Here's your standard 3-minute candlestick chart. Here's the tick chart. So I'm going to go to the tick chart. We're going to use that retracement tool to draw the pattern. All the pattern is high to low, high to low, and we see, aha, look at right where that guy topped out at again, right in our sell zone. So this would happen to be the third bearish pattern, right? Here, if I can move this out of the way and it doesn't change too much. Here was your first bearish pattern, high to low, shallow retracement. Here's your second one, high to low, retracement in here. So that box represents that third pattern. So that's what we like when we have 3 patterns in a row. When you have that third pattern getting complete, that's what we look for. So this would definitely be a sell signal for us right here. And we can base that on just a simple trend line break, right? There, I'll draw a trend line. Or you can draw it a little tighter too. You can take that isolated low to that one right there. Either way, this is a good sell signal for us right there. You had a full change of direction, etc. So the market gave us a sell signal right here at 70. The closing price was 70, right? So you can put in, here's what I like about the futures, put in an order to sell it at 70. As soon as it trades 71, you're guaranteed to fill. So we're going to get short at 70, and we're going to put our stop, the high of the move here is 74, so we're going to put our stop at 75, right? So we're going to sell it at 70 with a stop at 75, okay? So we're risking 5 ticks. So if we're risking 5 ticks, that's actually going to give us our reward because we're only following market-generated information, right? So if we have to risk 5 ticks, our reward has to be a multiple of our risk, okay? So we view ourselves as professionals. We're pretty sharp. We know how these markets move. So we're going to take a risk-reward here of 1.4. So we're going to take a reward to risk here of 1.4. Okay, so we're going to take the 5 ticks times 1.4, and that's going to give us 7. Okay, so we're short at 70 at 138.70 in the future. We have a stop at 138.75, so we have a 5 tick risk. So if we're only looking to make 7 ticks, we're going to put an order in to buy to cover our trade down here at 63. Okay, so we're short at 70 with a profit target at 63. So we're only looking to make 7 ticks here in the futures, and we're risking 5 ticks. Now some traders may say 7 ticks, that's not a lot to make. However, in the futures on a standard contract, 7 ticks at $12.50 is $87.50. Now let's say your commissions are a little high, you pay $7 in commission. It's still $80 you're going to make per contract. Now let's say we trade a 2-lot, because we definitely want to trade a 2-lot because that's going to give us the freedom if we want to exit one at a 7-tick profit and let the other one go, or we just want to take our money off the table. So one contract at $87.50, even after commission, maybe you're paying a little higher rate of commission, $7, you're still going to take $80 there. So on a 2-lot, that'd be $160. So $160 on a 2-lot for about 15 minutes of work here. So for 15 minutes, you make $160 there. Not too bad, right? And keep in mind, all we're following is market-generated information. We're not allowing our opinion to sway us. We're not using any other analysis. We're simply saying that the pattern was bearish because it continued to retrace less than 625. You continue to see that. So if you have you have a long-term pattern bearish, intermediate term pattern bearish, then you get this very short term pattern bearish right here, which is a little easier to see right here. There it is. We have that third pattern bearish. Take the signal, keep a modest reward to risk there. Keep a realistic reward to risk. Professionals don't look to make $300 by risking $100. It's more like you make $140, $150 by risking $100. The key is in being patient and waiting for these, what we feel are higher probability setups in line with multiple patterns. And all this comes back to using market-generated information. So that's what we mean when we say it's much easier to follow the path the market has laid out for us when we have no opinion. My name is Jay Norris. I teach trading at Trading University. Thank you so much for taking the time to see our tutorial and we look forward to seeing you again. Thank you.